Welcome to the special 2018 seasons of the Wealth Standard Podcast, celebrating life, liberty, and property. You are currently listening to Life Season 1.
Hi everyone, this is Patrick Donahoe. Welcome to a special edition of the Wealth Standard Podcast. My guest today is none other than Harry Dent. And if you have been in the financial space and looked at investment research and different opinions associated with economies and cycles, then you have definitely come across Harry. Harry has some awesome books that are out there, has a very different angle, and some people call him the Contrarian of Contrarians. I really think you are going to enjoy this episode. Harry Dent's the founder and the editor of Dent Research. They have a free newsletter. We're going to put some links into the show notes. And then he has a new book that just came out at the end of 2017 called 0 Hour. And the subtitle is Turn the Greatest Political and Financial Upheaval in Modern History to Your Advantage. So, without further delay, here is my interview with Harry Dent.
Welcome to the special 2018 seasons of the Wealth Standard Podcast, celebrating life, liberty, and property. You are currently listening to Life Season 1.
Harry, welcome to the show. It's awesome to have you. And it sounds like you are in what everyone would be envious of, a paradise of sorts in Puerto Rico.
Yes, with tax advantages on top of that.
Jeez. Well, I at least am. It's cold and wet and rainy here. But anyway, Harry, I've known about you for a long time. It's the first time, obviously, that we've spoken, and. For me, I have a kind of a philosophy associated with just, what people say about whether it's the economy or markets or investments. And it's always to have really awesome perspectives. And, this was years ago when you had this huge craze on hyperinflation and, the world's reserve currency is going away. And then you had this other kind of opinion as far as not a significant amount of inflation, but deflation. And, it's just been interesting to see kind of how the markets have behaved over the last, I would say, since the financial crisis and now hitting all-time highs, it seems like every day with, the advent of the, I would assume Trump administration. But, you have a contrarian perspective on things, and which I love because it helps really refine a perspective and make your, it forces you to ask good questions. So I love, I can't wait to have this interview really talking about what you foresee with 2018, and as well as the book that you had come out late last year. But why don't we start with just, we're looking at 2018. Like, how are you? What are you seeing as December 31st, 2018?
Well, we have a bubble that just never ends. I study demographic trends, economic cycles, and I study bubbles throughout history. And this is the greatest bubble in stocks and everything else, real estate and commodities, which have already been bursting, in all of modern history. And nobody sees it because when bubbles are happening, everybody's getting a free lunch. Their stocks are going up faster than ever. Their real estate's going up. You're sitting in your house and you're making money. Who wants to argue with that? But you have to argue with that because when these bubbles burst, they are decimating. I mean, we saw in 2008 and 9 how much real estate went down and stocks, even more than that. That was nothing compared to past bubbles and to the extent of this bubble we're in. We're in the next 2 to 3, 4 years, we're going to see the greatest bubble burst in our lifetimes. It's going to be like 1929 to 32. I hate to say this, but it's just baked in the cake here. Bubbles build. They go up exponentially. The more it goes up, the more people think, oh, it can't go down. No, any smart person would say the more something goes up, the more you should worry about the downside. So I'm a cycles guy, and I'm saying, look, this is getting ready to blow in the next weeks or months or whatever, but when it does blow, bubbles burst twice as fast as they build, and they go back to where the bubble started. And, that means, 75, 80% down for stocks, 40, 50, 55% for real estate. And people are not ready for this. And people think, oh, yeah, we already had the bubble burst. No, governments stepped in and shoved $12 trillion into the global economy to offset the last bubble burst. The bubble didn't get to burst fully, and when it does, it's going to be dramatic. And I've been bullish most of my life on the markets and the economy because of the dramatic baby boom generation coming through. But they're done, and now it's time for us to kind of see this bubble reset. And it's going to be very painful when it happens, and people aren't going to see it coming.
So I would ask, so it sounds like you're correlating the boom to more stimulus and monetary policy. So for the maybe for the average listener and the neophyte in economics and monetary policy and how central banks are able to influence that, like. Where are you coming up with $12 trillion? Because you said $12 trillion, and then you referred to like the international economy. So can you maybe explain like where that money came from, and then why it went international? Yeah,
$12 trillion since early 2009, when the economy was at the bottom of the last Great Recession and stock crash. Central banks in Europe, United States, and Japan have printed $12 trillion of money, which you asked where it came from. It came from nowhere. They just printed it and injected it into the economy to offset the downturn and the deflation in assets and debts and stuff that would have naturally happened, like in the early 1930s after the last great bubble in human history. They just said, oh, there shall not be a bubble burst. That's what the government said, and they kept printing more. And you can only do that so long. When you print money, interest rates go down to zero short term. Long-term interest rates, adjusted for inflation, go down to zero. And so people can borrow, and their mortgage loans are less, and their car loans are less, and companies can borrow at 3 or 4% instead of 6-7% and buy back their own stocks. And leverage their earnings per share. It's an artificial economy that no longer follows the fundamentals of when people naturally spend money, when natural business cycles grow and decline. This is the worst thing I've ever seen in history. Central banks have taken over the free markets, and special interests have taken over democracy. I mean, the Koch brothers can decide who gets nominated on the Republican Party or not, things like that. This is the worst thing I've ever seen in history, and it's going to end badly because these things cause the markets to get even more exaggerated, more out of balance in the economy. And that's not good. The economy needs to grow and then rebalance like any natural cycle. And economists around the world and central banks have said, no, we're not going to rebalance this time. Yes, we got over in debt. Yes, we overexpanded. But you know what? We're just not going to let it go down. We're going to print $1 for every downside of the economy. This is the worst and stupidest thing I've ever seen in all of history, and it will end badly. That's my promise. The question is, how long does it take for reality to hit?
So a follow up to that, I would say is because I agree, and what's been going through my mind for the last couple of years is how is it kept going? So the question I would ask is, we've been in this, really government intervention or central bank intervention to, assure that these, corrections are the severity of it's mitigated and it's gone on multiple times around the world. So, and then the narrative has been they're just going to continue to do it. So if they're just going to continue to do it, why wouldn't it just continue on? Like, what's your take on that question?
Well, again, you can't keep a bubble going forever. I always ask any man I meet, how long can you keep an orgasm going? That's my question. And nobody can forever. And bubbles are exactly like orgasm. And I'm not exaggerating.
No, it's emotional. It's purely emotional.
I look in my books and I show that you look at the greatest stock and real estate and everything bubbles in history, they look just like the Masters and Johnson's orgasm chart that was documented scientifically starting in the late 50s. It is an orgasm, and orgasms go up, they get more exponential, but then they get so exponential they can't sustain. And the problem is when they do burst, they burst suddenly.
Yeah.
Most stock bubbles that have burst in the last century, when they finally do, they go down 80% or so in the end, but 40%, half of that comes in the first 2.5 months.
Yep.
So when people say, well, maybe a bubble, but I don't want to get out because I'm, okay, it's better to get out a little early than a little late, because when they do finally blow, it is dramatic. And then we saw that in China in late 2015. Their second bubble burst, and it was down 42% in 2.5 months. That's classic. I mean, and when bubbles burst, everything bursts. I mean, banks go under because real estate crashes and stocks and people lose money. I mean, it's a negative reinforcement cycle that happens very quickly. But while the bubble's happening, I hate to say it, Patrick, it's like being high on crack or something. Everybody's like, well, we're happy. Don't tell us the bubble's going to burst. And I get assaulted in many media interviews for saying this is the bubble's going to burst. People are like, no, Harry, everything's fine. Why are you saying this? Well, I'm like, you're high, you know? I'm talking to a crack addict.
And what I would, I mean, it comes to, markets, the rationality of markets, right? It's the whole markets can stay irrational longer than you can stay solvent. It's that's what bids it up. That's what bids it up, and that's what makes it crash. And so I would ask, because I'm in full agreement with just kind of how behavior influences. You have a whole behavioral economics, like just a whole science behind how it works. But it's looking at why it hasn't happened, right? Because it keeps going up, and I would say the fear associated with losing is really, I would say, one of the primary emotions to why people just sell, right? And they keep selling until I don't know, and that's what I assume your take is, specifically in relation to demographics, because you've talked quite a bit about demographics and how we have this bulge of old people that are essentially controlling everything. I mean, baby boomers are controlling they're in politics, or at the higher echelon there, the corporate world, the banking world, and it's one of those things where they're all kind of coming to this point where they're going to exit, whether it's by decision or whether it's because the market pushes them out. So can you maybe talk about how you see this day of reckoning? Because obviously it's a lot of people have said it would have happened before right now, like before 2018, but yet we're hitting 25,000, we're hitting $20,000 on a Bitcoin price, which is just like, nobody knows how to explain what it, 1 in 100 people know how to explain what it is that invest in it. It's one of those, like, where do you see, like, what are signals you're paying attention to, which would, ultimately lead to that first domino?
Well, I tell you, Bitcoin may be the sign. I study natural cycles. We don't have natural cycles. After the 2008 crash and Great Recession, central banks stepped in and took over the free markets, set interest rates at zero, and that sets every other asset class. They've been printing enough money to control the economy, like putting somebody on drugs. Okay, yeah, maybe you're depressed or slowing down, but we're going to put you on a drug, on antidepressant, and that's what they're doing. quantitative easing is an antidepressant for the economy. Well, you can only do that for so long. And natural forces will set back in at a point, but only when these central bank policies fail. And the reason they fail, I keep telling Patrick, is very simple. They're going to bubble up the economy again to higher heights, which has already happened. I mean, the stocks are at new highs. Real estate now in most places are at new highs. The bubbles are greater than ever. Bubbles burst of their own extremes. I mean, there are cities around the world and countries around the world that people are moving out of, including Hawaii in the United States, because they're so expensive, people can't afford to live there anymore. Because of the real estate bubble, which has been exaggerated by low-cost money and stuff and foreign investment. I mean, money swishing around the world with this $12 trillion of printed money from all the major central banks. And the money's got to go somewhere. So what does it do? It goes into speculation in real estate and stocks and stuff. So you get bubbles everywhere. Bubbles will always burst. And people always say to me, Harry, well, what if this is different? What if we can just go up extremely and then plateau out and have a soft landing? And I'm like, you know what? If you can give me one example in all of history,
well, it's not rational.
You're going to have a hard time. I've studied all of history.
Yeah.
If you can give me one example where a bubble went up like this and then just plateaued out and went sideways, I'd say, I'll kiss your ass in public.
Yeah, well, that's rational thinking, right? But it's like that's not how markets work. Markets are irrational mostly.
Yeah, the more they go up, the faster they go up, the faster they go down. But bubbles burst twice as fast as they build, at least in stocks.
Yep.
So I keep warning people. There's going to come a day, probably in the first half of this year, I'm thinking in 2018, where the stock market all of a sudden falls 40% in 2 to 3 months, and then people will go, oh my God, this was a bubble. How stupid could have we been? I keep warning people in advance, and people don't get it. No, but Harry, it keeps going up, but it keeps going. That's what bubbles do. Bubbles suck everybody up into the Titanic, and then it sinks when everybody's on the boat.
So how do you look at like whether it's robo traders or high frequency trade? I mean, as you look at the innovation in trading in markets, do you think that is something that would mitigate a bust of that caliber?
No, it builds the bubble.
Okay.
I mean, 1987 was the first mini bubble we had in this baby boom demographic trend, which I've identified forever. And when stocks went up, these robo trading models just kind of exaggerated the uptrend. And then when it crashes,
they'll exaggerate
exaggerate on the other end because they react very quickly. I mean, the 1987 bust was 40% in 2 months, but basically most of that happened in 2 days when the robo models went the other way.
Okay.
So robo models only increase the bubble, and then when they crash, they only increase the crash. So anybody that says these robo models are going to balance out the markets, no, they only exaggerate it because they're robo. Just what we're talking about. I mean, they just react one way and exaggerate the trend, and then they react the other way. So this just makes, I mean, again, the 87 crash was the most extreme, short-term crash in history for a short period of time, more than 1929 to 32. Because this robo trading started to kick in. So this only makes it more extreme. And all this stuff about, we're going to have derivatives, and derivatives are going to, guarantee everything like insurance. This is insurance with no backing. This only created a greater risk environment thinking, everything's insured. And then when things fall apart like 2008-9, these things fall apart because there's nothing behind them. So this is very dangerous, and it's all manipulated. in Wall Street, in government. Governments are standing behind the markets, printing more money. Oh, we'll keep printing money. We'll keep making up for this. You can only live off of crack cocaine for so long before you collapse. That's my theory.
So maybe transitioning to, the demographic that I would say, has, in a sense, the most to lose, just because those that are younger, they have the capacity and the wherewithal to keep working, right? But the group that has the most to lose, I would say they're the ones that have the most fragile position in this all, which is the baby boomers. Like, what do you see as the period of transition? Because I would say the evolution of medicine and consciousness in regards to health, that people are now I'm talking comparatively speaking, not year to year, but life expectancies, have gone up relative to, maybe 50 years ago, 60 years ago. And you also have those that are staying in the workforce longer than they had anticipated. So how do you see, what signals do you look for with that generation that would cause you to say, okay, this is something to pay attention to. This is one of my flags.
Well, again, the baby boomers, the aging population, people like me, I'm 64 going on 65, have benefited the most from this financial bubble, because we own all the assets, the real estate, the stocks and commodities and even gold and stuff. When it crashes, guess who's going to get hit the hardest? The older baby boomers. The millennial generation coming up and still not fully in the workforce yet, they're facing oh my God, it's hard to get a job because these damn old people won't leave because they have to keep working in a slower economy. And they don't have the assets and stuff. But when these things drop, the cost of living is going to go down, and health insurance is going to go down, and things like that. It's going to, and education costs, it's going to benefit the younger generation. The younger generation is going to suffer this next downturn I'm talking about, just like the older generation, but the older generation is going to lose much more, and the younger generation is finally going to get some relief when we have to restructure things like Social Security and Medicare and Medicaid, which there's no chance these benefits can ever be paid to the largest generation in history, the baby boom. Baby boomers are going to have to suck it up, stay in the workforce longer, which is not good for millennials in that case. But everything else, they're going to have to delay their benefits, and that's going to help the millennial generation, because there's no way they can ever pay this. Economists, the only reason they justify these benefits and entitlements is they say, well, if the economy grows 4% forever and never has a recession, can kind of work out. Good luck.
Well, and you also have a pension
cycles.
You have a pension crisis on top of it, and so that's where.
Oh my God!
I would love your opinion, because the thing is, these are. It's not like they can snap their fingers and reform Social Security or reform Medicare. Same thing with pensions. These are just massive complex systems where if we're I would say that amidst of this frenzy regarding market declines and sell-offs. How do you see that going down? Because it's not pretty at all. There's really no scenario in which it's done like in a rational, organized, orchestration. To me, it's like, a massive cluster. And and I don't know, I've just always wondered, since since this is your expertise, how do you foresee that all coming to a head?
There's only one way it happens, Patrick. The whole system has to break down. Okay. This system is so built into everything in healthcare. There's so many special interests. Just look at this tax reform. Can we cut this deduction or that? Everything got fought, and they're going to be fought and after it's passed. It's built into stone. It takes a crisis where everything breaks down and people finally realize, oh my God, it's like when a labor union keeps building up wages and benefits to the point that an industry literally falls and cannot be competitive anymore, and jobs start getting lost and the industry starts failing. Then the labor union says, okay, we'll take half the benefits. Only then. And that's what has to happen for the whole economy. We cannot sustain the benefits and entitlements that have been promised, everything from pension funds and companies to Social Security and health care and Medicare, Medicaid. These things are impossible. A 4-year-old with a pencil could figure out these are impossible with the demographics of the huge baby boom retiring with a smaller millennial generation to follow them, the first time in history that a generation has not come up to new heights in numbers and capacity and stuff. This is impossible, but we still think it's going to happen. It's not going to happen.
No.
Yeah. And it's going to take a crisis for us to say, just like a labor union, okay, at some point in the next 3 to 6 years, we're all going to have to agree, oh my God, we're going to have to retire at 75, not 65. That's the solution. There's many, but that's the biggest solution. We're living 20 years longer than we did when all these entitlement programs started in the 30s, 40s, and 50s. But we're like, oh no, but we still get to retire at 63 to 65. We need to retire at 75 to put the system back near balance. And no politician could run on that platform. Everybody wants to get their goodies. We were promised this. We were promised something that's unrealistic. And it's not going to happen. It cannot happen even at 4% growth, which Trump is promising. We're not going to get that. We're at 2% growth in the last several years, and only that because of massive stimulus. We have zero growth or less ahead in demographic and workforce trends and spending trends, and even negative. We're going to have to come to a reckoning, and it's going to be painful, and no politician will be able to sell this. We're going to have to fail and accept it the hard way and finally realize, oh, we're bankrupt.
So how do you?
I'm in Puerto Rico right now.
Go ahead.
People saying Puerto Rico's bankrupt. I did an article in my newsletter a month or so ago. Puerto Rico's nowhere near as much debt per capita as the United States. They just don't have a printing press to cover it over.
So something I've been thinking. I'd love to hear your insight into this, because technically speaking, like as far as extending retirement, and it doesn't make any sense, and the outcome, like there's only one inevitable outcome, which you have to have a reset. Now what that looks like, I have no idea. I don't know how to think into those those details.
It looks like the early 1930s is what it looks like, Pat. I mean, I hate to say that. A reset only happens once in a lifetime, like the early 30s and.
But it can't. But the early 30s, that it was the very similar, like Knight on a White Horse. FDR comes to rescue with all these pork programs and all these other programs, and so it was kind of like, do you see that happening again from an international like governing body? Because this isn't like a U.S. problem. This is like a world problem to an extent. Especially first world countries, and so you have the international scope, but. What comes to the rescue? Is it an international, governing body? Is it, the U.S. that actually can, pull off, retaining some of its power and influence? I mean, what do you see there? And then I have a question about some demographic stuff too.
Well, again, in the early 30s, we didn't have quantitative easing back then to stave off. So the collapse happened, and banks failed, and companies failed, and unemployment was 25%. And then FDR comes in. He walks in right at the bottom. I mean, luckiest son of a bitch in history. I hate to say it. He gets elected at the bottom. He could have fallen asleep, and the economy would have turned around at that point because it already went to the worst. But then he did. Yeah, he did public works and stuff. And I tell you, of all the things you can do, printing money, no, that's not a good thing to do when you have a crisis because it stops the system from rebalancing. Yeah. But when you do have such a massive downturn and interest rates are the lowest of a lifetime, like in the 1930s and like now, and I think they're going to go even lower, the one thing you can do is build infrastructures for the future. But it's something that should be done to be calibrated such that the governments, they may be taking on some debt to do it now, but this debt's going to be paid off because these are infrastructures and utilities and things. They're going to pay off, and you're borrowing money at like 1%, 2%, 3%.
Yep.
I mean, the difference on long-term utilities and infrastructures on borrowing at 2 to 3% versus 4, 5, 6, 7% historically is huge.
Yep.
Just like borrowing a 30-year mortgage, the difference between a 4% mortgage and a more typical 6, 7, 8% mortgage is huge.
Yep.
So that is the one thing you can do to get around it. But the truth is, Patrick, is that, natural forces work. We boom and we bust. We have inflation, we have deflation. This is what I study. These opposing forces are what create the dynamics of innovation. We have the greatest innovations when we're in downturns in the economy, like the 30s and the 70s and now. And then those innovations move into the economy in the next boom when a new generation is spending and adopting these things, and then so and so and so on. It's a natural dynamic. Economists want to create a straight line up thing, never a recession. That is fallacy. Economists don't know their, you know what I'm saying, from a hole in the wall. They don't understand the economy. The economy needs this dynamic, and we have to have booms and busts. And economists want to say we never want to have a recession again. That's like a doctor saying, oh, we're going to conquer the cold, the human cold. I'm like, colds keep us healthy. Colds are the way when we get out of balance that we eliminate stuff from our body and keep us healthy, and they want to stop that.
Yeah.
Recessions keep the economy healthy, enforce efficiency and innovation, and economists don't understand this. So I tell economists, you don't understand the very thing you're studying.
Yeah.
Why should anybody listen to you? You're idiots.
Well, it's the thing is, economists are trained to be rational, right? And it's they're calculated. They have their algorithms. They have equations. They have modeling that says, if this happens, this happens, this happens, and this happens, then this will happen. But the thing is, it's like all of those things that they're trying to predict operate on an irrational basis. And so it's the human behavior, what people are going to do, how they're going to behave, how they're going to respond.
Right.
Like it's such an anomaly to them, and that anomaly typically is what, is the X factor, and that, screws up their entire model.
Yeah, their models don't work because their models are idealistic and they're rational. And the world is rational and irrational. They don't take into account the irrational side, and all of the innovation comes from the irrational side. Without the irrational side, we don't have innovation. So if economists ever did get us on a 3% growth model with 1% inflation and no recessions, we would die, because there would never be any innovation again. And that's what Japan has now. Yeah. Japan's on that model, and they haven't innovated anything since the early 1990s.
Well, what they're doing...
will ever again.
Yeah, well, I love... All right, so this is the question that I had, because that was a perfect comment that would segue into it. Because, I would say, the venture capital fund that's done the most, right, is Softbank, right, and it's out of Japan, and so they may not be innovating, but they're using their central bank and their leverage to invest, and that's where I would. This is kind of like the question that I haven't really been able to get my head around, but I look at what could essentially accelerate all of this is the fact that there is so much I would say investment, right, in technology and startup. And there's so many different markets. Salt Lake is one of them, and I'm downtown, and I grew up on the East Coast. But since I've been here, there's probably like well over 20,000 like apartment units that have gone up in the last like 5-6 years, and everybody's coming in for tech jobs, mostly technology that is being that doesn't have a profit. Right, that isn't some of them aren't even earning any money, let alone being profitable. But they're being funded, by really the massive amount of liquidity that's out there. But what some of it is doing, and more often than not, these things fold. But there is some technology that is really creating a different work environment. It's creating new systems, new programs. And from a baby boomer perspective, the thing I've been paying attention to is that the baby boomer generation isn't able to necessarily keep up with the way in which business is operating, which could accelerate their retirement. But what if you from a demographic standpoint, right? There may not be jobs for 70-year-olds or 75-year-olds because just the mental capacity that's needed to actually do it, they may not have the fundamentals. So how do you look at really the advent of technology and how it's impacted the workplace, how it's impacted communication, and do you see where do you see that variable having an influence on some of your theories?
Well, I mean, again, there's different dimensions. Generations grow up and become more productive and spend more money as they age until their mid to late 40s, and then they slow down, and that's one cycle. But innovation cycles are a little different. The generation cycles come about every 39 to 40 years, but innovation cycles, new clusters of technology. I mean, imagine, what did electricity, automobiles, combustion engines, phones, and then radios, which turned into TV. What did that do to our economy?
Changed everything.
It changed everything. Not just how we work, the assembly line, but where we lived, suburbs instead of cities or rural areas. I mean, it did change everything and caused a huge productivity surge. In addition to the demographic surges, so that's another cycle we studied. That's a 45-year cycle. I'm telling you, steamships peaked in 1875, railroads 1920, automobile saturation in 1965, and now internet saturation in 2010. Every 45 years, almost like a clock. And so in technologies, people will argue, well, there's always innovation. I'm like, yeah, of course there is. But it's when certain clusters of innovations move mainstream, again, like the internet and broadband and all these things, and personal computers and smartphones. When they move mainstream, because every great innovation in history starts slowly at first, moves into niche markets. Only the richer and urban people had automobiles at first, but then after World War II, everybody got them. And in a short period of time, that's when the innovation cycles pay off. And we're past that. Everybody already has smartphones and internet and stuff. We've already seen the benefits from that. And things like blockchain technologies are a way to extend that internet industry and make it more efficient and secure for financial transactions and other things. But that revolution has already peaked in 2010 or so. The next revolution in technologies, and I'm telling you, biotech and nanotech and all these stuff, are going to extend our lifespans, another 20, 30 years on average. And that's the only thing that can fight the demographic trends that are declining everywhere. Every country in the world is seeing lower birth rates, most so in the developed world, but even in the developing world, this is slowing and will change. Only if we live to be 100 or 120 instead of 70 or 80 would this demographic decline, and the demographic decline comes from as people get more wealthy and move more to urban areas, they have less kids. This is 100% proven in history, and that causes the very thing that's caused the demographic boom in the last several decades is reversing now because everybody's having fewer kids. And the only thing that could reverse that is instead of dying at 80 on average, what if we died at 100 or 120? Then we would be in the workforce twice as long, and that would reverse this demographic decline. So I think that's going to happen, but it's going to take a while. The next big cycle for us in innovation and technologies is 2032 to 2055. You know what? I'm going to die early into that cycle.
So do you not see those cycles, those technology cycles speeding up?
Oh, they always, that's all technologies are exponential throughout all of history. Everything is exponential. It took forever to go from single cells to multicellular organisms. It took billions of years. I mean, everything goes faster and faster, but the cycles we study are the same cycles, whether they be 45 years in innovation or 40 years in demographics or 35 years in geopolitical cycles or whatever. The same cycles happen and are consistent throughout history, but every cycle has more things happen quicker because you're right. Innovation, technological innovation is exponential. It's not linear. And human beings cannot wrap their brains around that. We want to think we just get better, linear, and then go to heaven forever. That's the way people think. And it's not the way that life actually happens. And that's the advantage we have to offer to people. I look at reality, and I look at cycles, and I look both at the rhythmic nature of cycles, but also, you're right, the best point you just made, innovation is exponential throughout all of history. Any generation that is older, younger, is going to grow up and see more change than the generation before them. I mean, anybody who would have told my grandparents in 1900 that we're going to have automobiles and flying around the world and internet and talking to Eskimos would have said, not a chance in hell.
No. Well, and that's where I would say, it's interesting because I haven't done, obviously any study into, the cycles of innovation and so forth. It's just, it really comes from more, observation and seeing trends and adoption rates and so forth. And I keep coming to this, this kind of converging point where you essentially have one generation that, the older generation that they don't understand how the younger generation is operating. I'll give you a perfect example. So I got a Christmas gift from somebody of the Alexa, like the Amazon Alexa thing, right? And it's free. And man, I had my nieces and nephews, and I had like 10 kids in my house over the holidays, and when we hooked that up, it's like they were there for hours just asking Alexa questions. It was fascinating. But my dad, my dad's going to be 74 this year, and he couldn't mentally process how it worked. He was like, so how does it connect to that? And he just couldn't. So that's my point is life expectancies may be prolonged, right? But the cognitive ability and wherewithal, how have you analyzed that? Because what I see, it's I on the Wall Street Journal, I think it was yesterday, these huge VC companies are vying for positions in the 5G networking, right? So 4G LTE, 5G, but 5G is what all of the kind of technology guys are saying is what is lacking to have a very robust IoT, the Internet of Things, where cars are communicating with other cars, refrigerators communicating with the microwave, and it's where you have a lot of connectivity, but because of latency and bandwidth issues, 4G and LTE doesn't do that, but 5G will. So it's kind of one of those things where as it's speeding up, and as the world starts to change there, and I look at the baby boomer generation, and do you see what I'm seeing, or is that maybe just a singular case with my dad? But I've seen it in other capacities too. But how do you look at the adoption of new things by older individuals, potentially not allowing them to be a part of a growing workforce because their services aren't viable?
Well, again, older people have more experience and wisdom. Younger people have more innovation. That's another curve we look at.
Okay.
And new technologies. I mean, first of all, just in my lifetime, I remember my first grandmother And like when she was 60, she looked like 80 today. I mean, older people now are younger physically, more healthy, more mentally alert, and can still be in the workforce. And they shouldn't be leaving at 65. They should be retiring at 75 or something. And imagine if we have biotech innovations where people at 100 are like people at 65 or 75 today. And that's when they retire. They enter the workforce at 20 to 25, maybe a little later in the future. It's 20 now. But they don't retire until 100, and then they retire between 100 and 110 or 120. I mean, they would be in the workforce more than twice as long. They would be healthier longer, more alert longer. They would innovate longer. I even make a joke in my books and say, what happens if you get married in your 20s and have your first family, a couple of kids, and then, you know, they grow up and stuff, and then you hit your midlife crisis, and since you're going to live to be 100, you have a second, and there's Viagra or whatever new biotech drug. What if you have a second round of kids and have another 2 or 3 kids? Guess what? Those next 2 or 3 kids are going to be much better than your first kid because you learned all your lessons on your first one. So, I mean, this is the type of stuff that can happen in the future that we can't foresee today. But I have a 500-year cycle. I have all types of cycles. And my demographic projections for the developed world and even the emerging world down the road is just that it just slows and slows and slows. Less babies, less new people. Yes, we live a little longer, but not that much longer. But what if we lived a lot longer? It would change the entire dynamic. And this 500-year cycle suggests that the world's going to be at its top, 120 years from now. And that could not happen in my demographic projections. It just wouldn't happen unless we live longer and are healthier and smarter longer and innovate longer and spend much longer and all these things and retire much later. This would not be possible. So I'm assuming this is the only possible solution to the demographic crisis we have around the world. If I just projected when we grow up, when we spend the most, when we die now, into the future, with predictable demographic trends of today, the whole world's going to go to damn zero in my lifetime.
Wow.
But that's not going to happen because their innovation always changes the equation. Again, it used to be in the caveman ages, you're lucky to live to 25. And then after that, 40. And then 65 in the 1930s and 40s was the average life expectancy. We could live to be 100, 120. The oldest people on the earth in the best circumstances of genes and health or whatever have lived to be 120.
Yep.
What if everybody lived to be that age? That is technologically possible. I think it's an inevitability because of technology. And again, the life expectancy just in the last century has gone up 20 to 25 years. That is huge. What if it went up another 20 to 25 years or more? And I think, again, what did we say earlier? Change technology is exponential. What if it went up 40 years, 80 to 120? I think that's going to happen in the next half century to century. I will not benefit enough from that. The millennial generation will benefit from that the most, the young people coming on today. And then, imagine being born today and living to be 100 to 120 instead of 75 to 80. That would change the world.
Well, and I think it is. I mean, and I would say that, yeah, the linear fashion that everybody, I would say innately assumes is, I don't know, it's just one of those misleading things sometimes. And that's why I always try to look at, just what is human nature? What are people driving to do? And I would say it's always to, increase time, okay, which obviously life expectancy, but it's also to increase energy, it's to increase earning potential. So I think the natural drivers of human beings, right, is really kind of giving us signals. But I find your research fascinating, and maybe we could talk a little bit about your newsletter and kind of what you're doing on a day-to-day, so people can be in tune with that. Because if we're not careful, we could probably spend 2 hours talking about all this stuff. But maybe actually one thing I wanted to ask you, and then we'll get into kind of what Dent Research and the services that you offer. So the one thing I want to get your take on is what's the time frame that you are assuming for blockchain, right? Because I look at the craze has been in really the greed factor, which is the huge price increases of these cryptocurrencies. But the underlying technology is what most people are, in my experience, have been oblivious to. Like, they're not able to explain it, they're not able to understand it. It's just like buzzwords that they use. So looking at blockchain, though, the application to banking, the application to real estate, the application to insurance, and you're starting to see conferences and companies and more investment in those areas. Like, what's the time frame? What's the time frame there? Because that in and of itself, right, will consolidate so many different companies, right, and jobs so I look at that as one of those potential technologies to be highly disruptive. Do you see the same thing, or do you still think it's in the early stages where there's not tons of adoption?
Well, it is in its early stages, but it is different from the internet. The internet is what I call a primary new technology surge on this 45-year cycle, and the internet rose from 1988 to 2010. I mean, internet and related technologies and broadband and everything else, and portable computers and stuff. That was that wave on the 45-year cycle, up 22 and a half years into 2010. Now that wave is subsiding. I see blockchain, not Bitcoin, but blockchain technologies as Internet 2.0.
Okay.
It's a way to improve the internet that has succeeded wildly in communication, from email to Google and stuff. I'm just telling you, my research business has tripled in productivity in the last 10 or 20 years just from these technologies. I used to have 3 full-time research assistants. Now I have a half-time research assistant.
Wow.
Because I can Google, and then anything I write, I can send to all of our editors. I mean, it's just unbelievable. But blockchain allows us to do financial transactions. The internet is failing on financial transactions. I have to change my credit card numbers every 3 months. I have to change my damn passwords every 2 days and stuff. The internet is failing on security, and the security is important for financial transactions. That people are not hacking to find out whether I slept with Angelina Jolie or something last night. They're trying to find out what's my credit card numbers and passwords so they can charge stuff to me.
Yep.
It's a financial thing. And the internet's failing on that. And blockchain, I think, is the answer to that. It's Internet 2.0. It's not a whole new revolution. It's what I call consolidating the gains and making the internet even better, but after the peak. So I would see that just like Uber and Airbnb, these are things that make industries already existing more efficient, but they don't create a whole new growth trend. They just make it more efficient and replace taxi drivers with Uber drivers. And so I see that for blockchain. And I see blockchain is going to be a rising technology between now and 2032 until the next major wave of nanotechnologies and God knows what else, and biotechnologies hits on our cycle. That would be 2032 to 2055.
Okay.
That'll be if we're going to live to be 100 to 120, that's when that will start to happen, not now. That's what I'm saying. Hey, I'm an aging baby boomer. I'm not going to live to be 100, 120, but millennials today and younger people born today could live to be 100, 120. I might live to be 85 or 90, which is more typical now, or a little longer than typical now. But this revolution, it has to move mainstream. Any revolution starts with the leading edge people or the richer people or whatever, and it takes a couple decades for that to happen and to prove itself. But when it moves mainstream, automobiles and the middle class, we didn't have a middle class until after World War II.
Yep.
And then the middle class exploded with automobiles and suburban livings and electricity and phones and radio and then TV. I mean, this whole thing happened. All those technologies were happening in the early 1900s and the roaring 20s, but they only hit the rich and the most urban. It didn't hit the everyday person. When these technologies do move mainstream, they have massive impacts.
Well, Harry, like I said, we could go on for probably another hour, but I know you have better things to do, and you are in paradise, and I'm not, so I'm the one that probably could go on for another hour, but it'd be difficult for you. All right, well, Harry, it was a pleasure. It really was. I appreciate the work that you do, and I ordered your book. It's
okay, great.
It's on the
Thanks,
way,
Pat.
but let's definitely get back on the horn again and continue the conversation.
Thank you for joining us as the Wealth Standard Podcast spends all of 2018 celebrating life, liberty, and property. Be sure to leave us a review on iTunes, and we'll see you on the next one.